Today we're going to hear from Craig McGrouther. He's the Director of Business Development for Lone Star Capital, and they've got almost $500 million in assets under management. Let's hear what he's got to say. Today I'm super excited to have a good buddy of mine, Craig McGrouther, on the phone with me, actually recording. He's with Lone Star Capital. He's been in the business a long time, and I'm hoping that you'll learn a lot from hearing what he's got to say. Welcome to the show, Craig.
Thank you so much for having me, and it's such a pleasure to see you virtually. We've been fortunate enough to see each other a couple of times over the last several months, so it's always so fun to see you, at least probably, 4 or 5 times a year now. It's kind of funny. You, just like us, are kind of always at the same events, so we're always looking to get 1% better each day, of course, and kind of take away, high-level overviews from these events, and also do the networking side to meet with folks like yourself and whatnot. So it's always just so fun to do that, to see you often. So thank you so much for having me on the show.
Yeah, you bet. We actually I just saw you guys at Lone Star Capital Summit, which was awesome at the World Trade Center. That was, if I remember right, that's your third year doing that one?
Correct. Third year doing the event, and we actually already saved the date, which hopefully will be there again next year. It'll be in September, I believe September 16th, I want to say, because we have so many people in the Orthodox Jewish community within our firm. So this year, the way it's set with the holidays is really most in September. But next year in 2024, it's going to be more October-based. So we're sliding up ever so slightly in September, which for those who will come, hopefully it means better weather for you.
No, look, I'm excited to be out there. I'll definitely help you guys promote it. I thought it was a great event. It was big enough to have a lot of different type of people to talk to, but small enough to where you could really build some of those relationships. So I think we had probably about 105 people were there or so. But yeah, it was a cool event. Your offices are amazing. Super excited that you guys recently moved into One World Trade Center, which is pretty iconic place to be. But you're in Phoenix though, right?
Exactly. So I'm kind of the floater in the sense, we don't use floating rate debt, but I'm the floater in the company. I split time between Phoenix for my residency, for tax purposes naturally, and then I'm also in Manhattan a lot. And then, of course, Chad, you know this, we buy deals in Texas. So I'm in Texas, every other month at least. So I make 6 to 8 trips to Texas a year when we are on site doing, reporting for new deals, and then also raising and kind of meeting our partners up there and kind of getting smarter in the market. But in addition to that, of course, as you travel so much, we do as well for conferences. So sometimes conferences are on the West Coast, sometimes they're in Texas, sometimes they're in Florida or New York, wherever it may be. It is nice for me to be in Arizona because it is a little more central to all the various locations that I need to go.
Cool. Well, we're definitely going to talk a lot about Texas today, but maybe before we get into that, maybe you could share a little bit more about your background because you did quite a bit of real estate before you even joined Lone Star Capital.
Yeah, absolutely. Well, and to your point, I kind of came out of my mom wanting to do real estate. I don't know why. It was kind of bizarre. I always wanted to sell homes. So right when I graduated from college, I went to the University of Arizona. I started selling homes. I was in that business for 7 years prior to transitioning into the principal side, which is what we're doing currently with the syndication, being the owner and operator. And now I'm on the capital raising and equity side for Lone Star Capital, which has been an incredible experience. I remember one day I was kind of getting beaten up over a $500 fee. And Rob, I called him that day because we're talking every single day on the phone about what was going on in our lives with regards to real estate and whatnot. And he was telling me how he got beaten up over a $35,000 fee. I'm like, okay, well, I want the bigger problem. I want to have the bigger game to play in. I want the bigger problem. I want that. And we mutually, were talking for a couple of years prior to me joining actually the firm. I was like, when an opening comes up, let me know, please. And he did so, in fact, line up a great starting point for me, which is about a year ago today. But I've been in the business now for almost 8 years. So.
Cool. So yeah, so you knew Rob from before Lone Star Capital then, or before you were part of it, rather.
Correct. Yes, I've known him since 2018. We're from similar areas in the Bay Area, and then we became very close during COVID of summer of 2020.
Awesome. Okay, cool. So yes, good to hear some background there. And maybe just as before we dive into it a little bit, What are some of the main differences you saw between, you had a long career, or semi-long, 7 years career in residential real estate, and then and then moved on to the bigger problems, as you say. What are some of the differences that are, I don't know, stick out in your mind that are pretty interesting?
Yeah, so I would say the differences are the relationships that you're building. I mean, you want everything to be compounding, but there's very much so a mercenary-like feel that you get in the residential real estate world. And what I mean by that is you're basically getting the fee of 2%, 2.5%. You're not really married to that property forever. You naturally want to do right and be ethical, which of course it's number one for us at Lone Star, and also I cared myself before. But you do that deal and you kind of move on and you're done. In this world, you're married to the deal indefinitely. So, that's going to be on your track record, on your resume. It's public. It can be scrutinized or appreciated one way or another how the deal goes. But what I really love about this in this new world that I'm in is the level of sophisticated people that we're working with because likely this is not your first real estate investment. And if you are involved in more than one real estate deal, you're inevitably a little bit more wealthy, probably a little bit more experienced and savvy, which makes for a really, really fun conversation and great people to work with. But in addition to that, you also get to be in a business where you're creating long lasting, repeat, programmatic relationships that are recurring and whatnot. So you do the hard work early, middle, and often and long in reference to building the relationships like what we've been doing for the last, over a year or so is getting to know you better, trying to work with you, trying to figure out solutions, and hopefully we create partnerships that will last, several decades. That's kind of what we're solving for now, which is really exciting. Not to say you don't want to create multiple year, multiple decade long relationships with people on the other side of the business, but it's more crucial because think about a home versus the multifamily. You buy a home maybe once every 8 years is the average, but some people buy a house, once every 30 years or buy and then never sell. This, it's kind of more in and out, in and out, in and out, rolling equity from deal to deal to deal and receiving referrals and, kind of growing one's network into your own and kind of sharing in that regard. So it's a little bit more robust and better in that regard, in my opinion.
Yeah, yeah, I love it. I've never spent any time on the residential real estate side of the world, but in terms of the commercial side, yeah, it's very much a relationship based business for sure. You and I are in the same mastermind group, which, we're developing relationships there. And I really love the part of it where people, like, it's an abundant mindset, right? People really try to help each other out. It's not a zero sum game. It's like, hey, how can I make you better? And then someone else makes me better, and we all rise at the rising tides, right? And even when the tides are sinking, if you got a tough market, like, you got people to lean on, and those relationships are really important.
You have people to lean on. You have experts in every field inside. And to your point, not the zero sum game thing is great. And that's kind of what I love actually about this side of the world versus the old side of the world. But, generally speaking, real estate's such a cool business where all parties can win on a transaction. The lender can get paid from doing a deal. The title person can get paid from doing a deal. The old seller, hopefully, if they didn't buy or in a distressed situation, they can make their money and their investors can make money, then we can make money on the acquisition of it and the exit of it. And then also all the employees who work on the property make money because they have their job there. So many people get impacted when there's deal velocity and transactions occurring. So to your point, so many hands and mouths can get fed, which is great.
Yeah, I agree. So maybe we can dive into a little bit more about Lone Star Capital, and now that you've been there for a while, and how you're really helping to develop that company. Maybe before we start diving into some of the deals, maybe a little bit of background about Lone Star Capital, what you guys are focusing on, and eventually I want to bring us around to talk about current day, talk about the market, but let's talk about history and where Lone Star Capital has come from and where you guys are going.
Yeah, so Kent and Rob formed the company in 2018. We currently have $500 million of assets under management because today we just closed a $105 million acquisition, which we're thrilled about. That's the biggest deal that we've done yet. Utilizing a unique tax abatement program, which is very exciting. So that's a really cool way to get great returns in a very challenging market. So we're very thrilled about how that all transpired and all the work and effort associated for all of our parties. So that's the biggest deal we've done yet. But essentially, we're 2018 formed, look to buy workforce housing, which is renter by necessity with inherently a little bit more of a sticky tenant base. We have our own in-house vertically integrated property management and construction management team in-house, doing no third-party assignments. only for us. And we look to buy what is called Class B apartment complexes, which, can be anywhere from $1,000 to $1,600 for a rent price range. So not what, a Santa Monica apartment would rent for or a Manhattan apartment would rent for naturally, but what most of America can do. And the great thing about that asset class and type, which Chad, I'm sure so many of your guests know, or sorry, guests and listeners know, is you can't build or replace that at an economically viable price from a replacement cost, right? Replacement cost now is substantially higher than what we're buying that at, which is nice. There's a moat around that building. So, if you buy kind of the higher end apartments, what happens is someone can always kind of come in and maybe undercut that. Or if you have a high end apartment, when there's new units coming to supply, your rents will naturally go down because it's not as nice as the latest and greatest. But what we're at is more of a moat around the fact that more people than not are in, that $1,000 to $2,000 rent range. So we kind of look to solve for that. And typically speaking, there's some inefficiencies with these properties. So we look to hold properties for 3 to 6 years, typically speaking, adding some value add component to it. Maybe there's a mismanagement play. Maybe there's original rents. Maybe rents are below market. So whatever the market gap is, we look to solve for.
Yeah, look, I mean, I love that market. I've been in that market for a long time as well. Try not to do too much in the Class C, although I have done some. I try not to do any in the Class A. So yeah, I'm with you for sure on that market segment. Which is a big part of the reason why I want to work with you guys. Eventually, we'll do a deal together. But you guys have also chosen to focus exclusively on the Lone Star State,
Yeah.
hence the name Lone Star Capital. And maybe you could speak a little bit to that about what it's been like, starting out heavily in Houston and then expanding to Dallas, and now I understand maybe San Antonio. So maybe talk about the Texas market a little bit.
For sure. So, funny enough, Ken and Rob were both looking for deals all over the place when they first met. And they got momentum in Houston, of all places. They liked the fundamentals. They looked everywhere, of course, searched high and low under every single rock possible to see what the best market would be. But they got traction in Houston, which is a great spot. So since then, we've got about now, I want to say, $400 million of assets in Houston, all multifamily deals, of course. And we are really big believers in being efficient and having a very deep focus. If I'm a capital allocator, if I was going to raise $100 million and place it throughout America, I would likely want to, put, X amount here, X amount here, X amount there, so on and so forth, right? But if I'm a sponsor and I'm looking to deploy equity with a group, I want to be very narrow and focused and niche down and only a couple places, maybe just one state. And we've been able to receive immense amount of benefits from that. Economies of scale, being able to have our own in-house property management team, and then also getting best and final looks without maybe even the highest price and having a good reputation to close. So because of that, we get incredible deal flow and benefits from being very specific and focused in one market as opposed to being all over the place, of course. Eventually, will we maybe expand outside of Texas? That's likely on the horizon within the 10-year business plan. But to your point, we've got a bunch of assets in Houston. We're looking to expand into Dallas and in San Antonio in greater depth to Dallas because we've got one closing there before, but Dallas is so tough right now. San Antonio is interesting because it's very reasonably priced, so it's very affordable. Great economics, but it doesn't have as much of an insurance risk that Houston has, or Florida or any of the Gulf Coast markets have. And then similarly, when you compare it to Dallas, it's not as competitive necessarily, but the fundamentals and numbers check out a lot more. So it's funny. We always say this. If you're buying for the story, you're going to buy in Dallas. If you're buying for the numbers and the fundamentals, you're buying probably in Houston or in San Antonio. So we just figure adding to San Antonio and into Dallas and expanding to Houston gives our investors geographical diversity within Lone Star itself, because we do have so many investors, in fact, that if they think of and only want to invest in Texas, we're the go-to people. But eventually, to only having your eggs in that Houston basket becomes, slightly financially irresponsible, and we can appreciate that. So giving the three market options makes us feel really comfortable, and we feel as if there's about $500 million a year of acquisitions to be done respectively in those three markets.
Yeah, no, I agree. I kind of started out a similar way where I was investing only in Southern California, and I was operating in my deals in Southern California. And it was just like, I was thinking about my money because I put my money in the deals, and then I thought, wow, it's like, I thought I'd had too many of my eggs in one basket. And that was really the impetus for me to decide to start investing out of state. And then thinking also about my investors and wanting to diversify a little bit more out of California. So we've done that. Some questions on some of the challenges that Texas has, and like there's challenges everywhere, of course, and that's where the sponsor team really comes into play. I know, like for us in California and Florida, like we've hit a lot of insurance headwinds, right?
Yeah.
It's been really, really tough. You briefly mentioned about some of those headwinds in Houston, but I know Texas as a whole has issues with property tax going up each year, and quite a bit. And ignoring the last deal that you just closed today, which is a tax abatement deal, which has its own advantages. But maybe we could speak a little bit to the Lone Star portfolio outside of the tax abatement deals, and talk about how you guys are like mitigating the property tax risk, or in some of these areas mitigating some of the insurance risks and some of those other costs that escalate over time.
Yeah, well, so there's definitely a dance and a game to play. Most sponsors definitely pursue, arbitration in reference to property taxes. So we have the best guy possible in the business to help associate or assist us with that process to make sure that we're going to get the lowest assessment for basis of taxes, which is great. If we're not doing, of course, a 100% tax abatement deal, which we just did, as you mentioned. So that's number one. Number two, on the insurance side, it's crazy. I've heard some places in California, and you would know better than I would, of course, in this, but they're not even giving insurance, or the insurance premium's so high it's crazy, especially with the fires going on. We've got earthquakes, various other situations in California makes it very, very difficult. In Texas, and much like Florida, we've got, water, weather risk, and whatnot. So one way we've really been able to mitigate that is being so focused and niche, as I kind of just mentioned before, but that's having a master policy within Lone Star Capital itself. So having a master policy is really, really beneficial because we're going to get the benefits and efficiencies of economies of scale and going to get the best rate possible because we've got thousands of units there. If you're just a sponsor buying a deal in Florida, a deal in Texas, a deal in California, a deal in Nevada, well, you don't have enough juice to necessarily get the best deal possible. And we're actually in the process right now of actually totally revamping our insurance policy as well, which actually might give us deep haircuts and discounts on the entire portfolio to the tune of a couple $100s per door, which you can imagine that extrapolated on a couple thousand units is an immense amount of saving and some very solid investment alpha that we'll be able to create for our investors that work with us. So it's kind of funny. The bigger you get, usually the better deals you will get on insurance, sometimes even lending, and then also maybe even better looks on properties as well. And that just goes back to what we kind of look to solve for that Lone Star, being very specific. We want to be the one-stop shop Texas people when you think of, multifamily real estate.
Yeah, I hear you. We actually today we're filming this in November 2023, and literally today we just re-signed on our master policies for our buildings. And even though we're doing the master policies, probably saw like maybe a 12% increase in insurance costs. And now this is California, and we were able to, that's a lot lower than a lot of the increases other people are seeing. But still, I mean, like we didn't anticipate 12% increases when we were originally doing the underwriting. So that does create some headwinds into the original pro formas. You got these additional costs. So it's definitely a challenge. We've had bigger problems on the Florida properties where you've got a lot of insurance carriers that have exited the market. So that's putting a lot of pressure over there. And
12% is good. I mean, 12% for you in California is actually relatively low if that's all it
oh
takes to
yeah,
reach the lump. I mean, yeah, it's hard to underwrite that and anticipate that to your point, but shoot, compared to Texas, Houston, Florida, I'm sure, the Gulf states and whatnot, that's not bad at all. That's pretty competitive. The Carolinas are getting beaten up too. But 12% is actually pretty reasonable, all things being considered. That's definitely probably beating the market average for increases. So good for you for sorting that out.
yeah, no, I mean we're seeing 100% increases on some areas in Florida, so it's brutal, But what does that do? Like as the asset manager or the sponsor, like now you've got to figure out, okay, I got to take this hit. There's nothing else I can do. I've got to get insurance, right? There's very strict requirements from the bank covenants, so that's almost like a non-variable, right? It's set. It is what it is. So now what we're forced to do, and I'm sure you guys are also, is figure out, okay, where else can we cut costs and where else can we increase income, right, to help make up for some of those differences? Because we still want to strive to give the investor returns and create a good deal, and it's forcing us to get a lot of a lot more creative on other areas.
Absolutely. No, you have to get more creative and you have to get more nimble and think about solutions to add other forms of income or to, offset the increases as you mentioned. But the good news is that, you're not alone. We're not alone. As an industry, we're all facing this. And this is the value of community. This is the value of why we're part of Raise Masters and you're part of, the various other groups and why we're always going to networks and meetups because you don't know what insurance person you're going to meet. You don't know what lender you're going to meet. You're not going to know what business partner or business idea that will come from it from all the education that you always do. And that's one thing I've always admired about you, Chad, is that you're always at every event networking, figuring out who to meet with. And likewise to us, we want to put ourselves with the best and brightest and to make sure that we're getting all the best information possible to really help our portfolio because it's times like now when things are kind of going crazy or if rents are softening, if rates are going up, and then your insurance costs are going up. These are all things that are going to drive your NOI down. So how can we survive and thrive through these next couple of years that are going to be tough is what's really going to define us and separate us. That's what we're solving for and looking to achieve every single day is just to kind of rise above that.
Yeah, I agree. So I know you guys have done quite a bit less deals this year. 2023 has been a slower year in terms of acquisitions for you guys. Where do you see Lone Star Capital and the market going in like the next 12 to 18 months?
Yeah, so I think we are in for a very, very tumultuous and rough road coming up. What I mean by that is bridge and floating rate debt is very challenging. And thing is this, no one's perfect, but essentially if there's any deal that, you want were to acquire those recently, it's going to be very challenging. It's hard to outrun the math on that there, but we are very excited for the opportunity that is at hand because we do feel as if this is the time to buy deals where anything you could buy coming up probably from now and the next 24 months, it's almost gonna be impossible to not make money on, which is nice. Money is not hot like it used to be before. It's not flowing and as fluid as it was. So every dollar you raise right now will feel like $2 before. But this is the fun part. So, I see us acquiring about $300 million of assets next year in 2024, hopefully in 2020, or sorry, and in 2025, hopefully a half a billion as well. Really expanding that, really adding more capital partners to help with that, and just acquiring great deals that make actual awesome fundamental sense versus before, everything got so hot and so crazy. We're all trying to buy in every single part of the market, but I'm excited for the opportunities to come up, but it will be very challenging with equity here. But, I think we're just going to double down and really focus and really enrich ourselves with relationships and, find creative ways to get deals done by any means as this market shifts coming up. So looking to have more Chads in our team that can, bring us equity or partner with us and, be lead GPs with us is the name of the game, whether it be joint venture situations, fund managers, you name it. Looking to fill up the capital stack and, just add to our arsenal.
Got it. So did you say you guys are targeting 300 million in acquisitions for 2024?
That is the goal, yes. So we're going
Yeah.
to be land around 150 million, I believe, this year, which, our goal is to do 350, but all things being considered, where the market went and how crazy everything got, we're pretty proud of that number. And, we're proud, but we're not satisfied just yet. The biggest thing for us, though, is to buy deals that make sense. As you know, and saw front row, we actually walked away from about $1 million this year. Did not feel good to do that, but we had to do it due to, the deal not making sense with, interest rates running up, which everyone had to deal with. But that was a setback that the whole market had to endure. But we think rates are going to stabilize here coming up from a prediction perspective. That's what I think. We may have one more hike here coming up in November. Then it'll hold. Then they'll cut probably in Q3 is my guess. So with that said, we got a kind of a funky year coming up with maybe rates getting cut with elections. That usually creates for a slightly tumultuous market, but tumultuous markets and shaky markets create opportunities. We want to be there, ready to go. We're fortunate to not have many legacy issues at all. Actually, zero legacy issues or problem childs in the portfolio, if you will, which makes for us to be able to play offense and get excited to get greedy when others are fearful, as Warren Buffett would say.
Yeah, I agree 100%. It is interesting what it's going to be like. I think there's a lot of opportunity on the horizon. I mean, I know like on our deals, I'm sure your deals, right? If you had to sell some of your deals today, you'd be taking a haircut on some of them. But fortunately, you put together good debt on it. You got time is on your side. I know we're in the same position. And yeah, definitely, anyone who's selling today, they're selling because they have to, right? They're being forced to because of the debt side. It's not a market to willingly want to sell, but if someone has to, they're being forced to because their loans are coming due, and then that's where the opportunities are because they are going to be selling at a discount, and it helps, like you mentioned earlier, it helps to have those relationships with some of the brokers that are able to bring you some of these deals even before they hit the market and get in on them because there are going to be some distressed deals. I think that's the silver lining and an opportunity that we're going to be chasing in the next 12 months.
Most definitely. And, if you are selling right now, if there's a situation where, hey, you bought the deal in 2015 and, you had 7-year debt and the debt term's coming up for 2016 or whatever, maybe 2017, and there bought, made money. What a great time might be to recycle some equity into, the market currently and, 1031 exchange into a new opportunity. So, I think it's always exciting. And I think the biggest thing to think about is time in the market, not timing the market. We obviously want to time the market perfectly, but if you dollar cost average accordingly, you'll be a-okay. So, I think the biggest message we have for anyone is like right now, it's going to be tough to feel good about giving any money to any deal, but we assure you that it will be rewarded handsomely should you, play the game correctly and you deploy cash when others are not willing to do so.
So, a question for you. You mentioned the 1031 exchange, and I know Lone Star Capital has had a few exits in the past. Did you guys, and do you recall if you guys did a 1031 exchange into other buildings? And if that worked, was that like your entire group, all your investors did the same thing, or did some split off? How did that look?
Yes, we have done two deals where we've exited and 1031 exchanged in. And the way it works is, let's say there's a pool of 10 investors to make it simple, and it's $1 million, and they all just equally have $100,000. Let's say if 900K went, one investor dropped out, the 9 of 10 would exchange, that one partner would cash out, and it would be an entity of that 9 people into the next deal. And then we've also similarly had folks who exited their deals in 1031 exchange via the tick structure into our opportunities.
Gotcha. On those, the two deals that you did have, both deals had options to 1031 exchange into other projects?
That's correct, yes.
Yeah. I mean that's the name of the game. I mean it's one of the things I love about real estate so much is like you could make all this money, all these gains, and instead of paying a capital gains tax on them, you can forego that, postpone it, reinvest all those gains, 100% of those gains into a new property via the 1031 exchange vehicle. And it's a great wealth building vehicle that's really advantageous in real estate.
Yeah, it's crazy because it's not as if you're just getting, maybe the 7 or 8% return that the real estate world has to offer. But when you compound and roll that and not pay, 85% or 80% in capital gain tax long term, the delta of investing in real estate is a lot greater than you would think. So, that amongst, getting good levered returns is really the alpha that we can create in real estate investing that the stock market, just doesn't have to offer.
And just for anyone watching this, we're not guaranteeing or promising returns. These are just normal things that we're sharing, informational purposes only, of course. All those details on risks are in the PPM and subscription agreements, but we love to share our thoughts nonetheless. So,
And
so
the G word does not exist in real estate.
yeah, yeah. So, Craig, if people want to learn more about Lone Star Capital or get in touch with you, what are the best ways?
Yeah, very easy. Thank you so much for asking. I appreciate that. You can reach me out at craig@lscre.com. Craig at lscre.com. Be more than happy to answer any questions there. If you're looking to maybe listen to a little more educational information from Rob and myself, we have a podcast called the Capital Spotlight Podcast, which you can find us on all platforms. But for video content on YouTube, we'd love to have you. And hopefully, you'll make a cameo appearance on the new show that I'm launching, Chad, coming up on Fridays. We'd love to have you on there, learning more about you and just kind of letting everyone know your story, your unique engineering background, your TV background, and how you manage deals. And our father of so many kids, you have a very busy plate. So I think people are very curious to know your story more and learn more about you.
Yeah, no problem. Happy to hop on the show. And also, your partner Rob wrote two books on underwriting. So if anyone really wants to dive into underwriting, we'll include some links to the books there on your desk. They're ready to go.
Here, the other one is MIA, but it's structuring, or I think it's multifamily, definitive guide to multifamily underwriting. So there you go.
Yeah, both great books. So Cool. Well, thanks so much, Craig. Really looking forward to working with you guys some more. Appreciate you coming on the show and sharing your experience and some future thoughts on where the market might be headed. We appreciate it. Thank you.
Thank you, Chad. Always a pleasure, and look forward to seeing you soon, hopefully.
All right. I hope you enjoyed that talk with Craig. He's been instrumental in helping Lone Star Capital grow. And next year, they're poised to acquire $300 million worth of assets. Please drop us some comments. Let us know what you think. And if you'd like to contact Craig, check out his information in the show notes below. Thanks a lot.